Today we conclude our series with part 3 of the Canadian perspective on Benjamin Graham's The Intelligent Investor. If you haven't seen part 1 or part 2 yet, I recommend starting there, because in this final part we're building on those lessons with a deeper look at speculation, the importance of market history, and the timeless principles that still shape Canadian investing today. Let's begin with one of Graham's strongest warnings: the danger of speculation disguised as investing. Graham points out that speculation becomes especially seductive during times of rapid growth, when everyone believes they've found a shortcut to wealth. We can see this play out time and again in Canada. Take the cannabis boom of 2018, when legalization created a frenzy of investor interest. Stocks surged, valuations soared, and many Canadians poured in, believing it was the start of endless growth. But within a few years, most of those companies saw massive declines, and thousands of investors lost money. Another example is the cryptocurrency craze, where Canadian exchanges saw record sign-ups in 2021 before the market collapsed in 2022. Graham would say that these are not failures of the market, but failures of discipline, proof that without a margin of safety and sound analysis, speculation will punish the unwary. Importantly, Graham doesn't say that speculation should be avoided entirely. He simply insists on honesty. He tells us to cordon off speculation from real investing, treating it as entertainment or a side hobby. For a modern Canadian, this might mean setting aside 5% of your portfolio for speculative trades, whether that's crypto, a junior mining stock, or a hot tech name, but keeping the rest of your money in stable long-term assets. That way, you enjoy the thrill without putting your financial future at risk. Next, let's turn to lessons from history, because Graham believed that ignoring history is one of the greatest mistakes an investor can make. Markets will always rise and fall in cycles. This much is guaranteed. In Canada, history offers plenty of reminders. Consider the oil crash of the 1980s, which devastated Alberta's economy and dragged down the entire Canadian market. Or the collapse of Nortel networks in the early 2000s, which at one point made up over a third of the TSX index before it imploded during the dot-com crash. More recently, the 2008 financial crisis showed how interconnected Canada is to global markets. Our banks fared better than those in the US, but Canadian investors still suffered significant portfolio declines. The lesson is clear: cycles will always come and go, but disciplined investors who avoid chasing fads and stick to fundamentals eventually recover, and often come out stronger. For Canadians, this means recognizing that volatility in resource-driven sectors like oil and mining is normal, not a sign to panic. The key is having the patience and courage to hold strong companies, or even to buy more, when fear is at its peak. Now let's expand on Graham's timeless principles in today's Canadian context. One of his greatest ideas is the margin of safety, which means leaving a buffer between the price you pay and the true value of what you're buying. In practice, this means refusing to overpay for stocks just because they're popular. It also means building diversification into your portfolio. In Canada, investors can achieve this margin of safety not only through stock selection, but also through smart use of our tax-advantaged accounts. Holding dividend-paying stocks inside an RRSP or TFSA, for instance, maximizes long-term compounding by minimizing taxes. Graham may not have had these Canadian tools in mind, but his principles align perfectly with them. Protect your downside and let compounding do the heavy lifting. Another timeless principle is the power of patience. Graham's research proved that investors who stick to a steady plan outperform those who constantly chase the latest idea. For Canadians today, This might mean investing steadily in broad market ETFs, like those tracking the S&P TSX Composite or the S&P 500, rather than trying to guess which individual sector will surge next. Our market is relatively small and heavily concentrated in financials, energy and materials, so diversifying internationally is also a way of practicing Graham's advice. Over the long run, it's the slow, consistent investor, not the flashy speculator, who wins. Finally, let's touch on one of Graham's most enduring insights, that investing is not about beating others, but about controlling yourself. He argued that the true battle is against our own emotions, fear in downturns and greed in booms. Canadians have lived this lesson through multiple bubbles, from cannabis to crypto to housing. And yet, those who stick to disciplined strategies, buying quality, holding through turbulence, reinvesting dividends, end up ahead. The lesson is simple but powerful. You don't need to be brilliant to succeed, you just need to stay rational when everyone else loses their head. As we close this series, let me leave you with 3 final takeaways from Graham's wisdom, applied to Canada today. First, speculation can be tempting, but it must be limited and kept separate from your real investments. Second, history repeats itself, and investors who learn from past crashes are better prepared for the future. And third, long-term patience, discipline, and a margin of safety are the real keys to building wealth, not flashy trades or predictions. If you enjoyed this series, I encourage you to watch parts 1 and 2 for a deeper dive into Graham's philosophy and methods. And if you found value in this video, please subscribe to Magister Factotum and hit the bell so you don't miss our future explorations of finance, investing, and Canadian perspectives on building wealth.